Hi, Steve Spangenberg here to answer some of your questions, actually all your questions around the few subjects that have been on a thread on Facebook. And number one, I'm going to tell you this, that I'm not going to get into nitpicky. In fact, I'm just going to refer to my website here for tax tips rather than putting a whole bunch of threads on Facebook, because what happens is it just gets very crazy on Facebook. So you can reference this website and also this particular audit that was brought up on the Young Living thread about Amway distributors, and of course. So I'm just going to go over a few things. Number one, as far as sharing the oils and sharing lipstick or sharing samples, as you might have noticed in that audit, that the IRS had no problem with them sharing portions of products and claiming them as samples or promotions. The IRS had no problem with that whatsoever. And in fact, and I'm going to cover why they didn't have, why actually in the end that they had a problem with the whole, their whole business, if you want to call it a business. So as far as the one drop of oil and everything, hey, you know what? I feel comfortable with that. I've used it for over 35 years and it stood the test of an audit, so I'm pretty comfortable with sharing things as promotions. I'm really comfortable with being able to write off all your oils or all your makeup if these things I'm going to cover are covered by you. Okay? As stated in the thread, yes, you as the taxpayer are ultimately responsible for what goes on your tax return. But I'm going to tell you in this video, I'm going to directly reference this audit because I read all 41 pages of the audit and I picked out the snippets that I want to go over, wrote them down, so I'm going to be referring to my notes and also referring to the board here so that you can follow along and get something out of this. Let's look at this audit. Number one, they did not lose the audit because they wrote off a whole bunch of stuff. They did not lose the audit because they took items and put it in another business or just wrote off a whole bunch of stuff, period. Okay? They lost the audit for a number of reasons. I'm going to go over those right now. Number one reason is that they filed late. Up to about 22 months, they didn't file their tax returns. Now look, folks, the number one thing that you can do to make the IRS extremely mad is to file late. Okay? Even if you have to go back and amend your return for some information that you might not have had at the time, or some things you might have found in the meantime that could be to your benefit, file on time. Okay? I cannot stress this enough. Please file on time. It just pisses them off. All right? Just to be frank about it. All right? Now, with that being said, on my income tax reduction package that well over 5,000 people have, there's a chapter in that income tax reduction package. It's called Before You Start. I don't even go into any deductions. I don't go into any strategies. On all my tax calls, I say these things must be present, okay? In order to take advantage of these deductions, you have to do at least these three things, okay? Number one is that you have to have an intent to profit. Now, if you read the audit or didn't read the audit, that's okay. But specifically in that audit determination letter, they stated that the party did not have a clear intent to profit. What were they lacking? Okay, number one thing they were lacking was a business plan. They did not have a business plan. They did not have a marketing plan. and they did not have a financial plan. They did not have a plan, period. Okay? They had a real estate business and they had their Amway business, but they had no plan. They had no evidence that they could show the IRS that they intended to profit. Now that doesn't mean that you have to show a profit. That means you have to show an intent to profit. Okay? They had no plan in place, no written plan, nothing in place. Okay? They had no financial projections. In fact, it's very clear in that audit. They state that the party did not have any financial projections. What's interesting is the IRS looks at a funny thing called a break-even. Now, I don't know why anybody would just want to break even in business, but they point to this. They had no break-even analysis. They had no analysis in there stating this is what I need to break even. So my kit and my time, etc., nothing. No plan. Let's just leave it at that. No plan. My question to anybody watching this video is, do you have a written business plan? Do you have a written marketing plan? Okay, this is why I go over this in my tax reduction guide. It's a chapter before you start. And I'm going to say that about 50 times in this video, and that's okay because you know what? I'm still, to this day, have clients that don't have a written business plan. Go figure. Okay? No written business plan. Marketing plan, financial plan, break-even analysis. Okay? The second thing is they pointed to, in this audit, they pointed to that the party spent significant amount of time in their real estate business, etc., etc. But they had no, once again, they had no evidence of activity, business activity. Okay? What are you doing every single day for your business? This ties in, this should mirror your business plan. What am I going to do every day? I'm going to go to meetings. I'm going to go to functions. Why? What happens at those functions? What happens at my parties? What kind of database am I using to get customers? Okay? No evidence of activity. Okay? That's huge. I mean, the problem is that and they focus, they even state in that audit that their focus was recruiting. Which for some reason, don't ask me why, some reason the IRS gets upset if you focus just on recruiting, okay, and not the retail end of the business. Excuse me one second. This is why back in the 70s or 80s when the Better Business Bureau or the I can't remember, whoever took Amway to court, they put in there the 10 customer rule. Part of your business activity is to run your Young Living business, run your Send Out Cards business, run your Tastefully Simple business. Whatever business you're in, you run it like a business. This business has two components. It has recruiting and it has customers. Okay, the biggest mistake that I see on people's tax returns is they don't have any sales. They have no sales. I mean, literally, I did a tax return 2 days ago that this is what the person had. $75 in sales. Okay? 75 bucks in sales for a whole year. A whole year. Okay? Now, if you translate that into Young Living, maybe that'll be 1.5 bottles of oil. I mean, really. Okay? That's not a whole lot. What are you doing? Are you selling? Okay? You have a retail business along with the fact that you can recruit other people, sponsor other people into the business and make money on those overrides. All right? Legitimate part of your business. But are you doing both? Are you doing both activities? All right? Number 3, is that they had shoddy record keeping. Their books were stupid. The only time they ever looked at a profit and loss statement is when they went to get their taxes done. Now you tell me a business out there that looks only at their profit and loss once a year is when they go get their taxes done. Well, I don't know how much money I'm losing. I don't know how much money I'm making. And once a year I get together with my tax advisor and they say, oh, I had a $10,000 loss. Okay? Why? They have no good records. Now, in the thread it said they got in trouble for writing off mostly all their things. No. They didn't get in trouble for writing off almost all that what they purchased. They got in trouble because they couldn't do the records. They did not have, and I quote, distinguishable. Distinguishable. I'll just kind of spell that out like that because I don't feel like spelling it. They didn't have distinguishable record. They didn't have records saying, yes, this went to the real estate businesses and this is how we kept our books. Okay, none of that. All right? They had no clear record keeping. All right? And these are the three things that I go over that are must-haves in the tax reduction guide. Must-have. You must have an intent to profit evidenced by your business plan, marketing plan, financial plan, and a break-even analysis. That is included in that package, a business plan template. How many people took that up? Nobody. Okay? On the last tax call that I did, not one person took that up. Okay? And I can guarantee you that 95% of the people on that tax call did not have a written business plan. All right? Activity, evidence, date book. What are you writing in your date book every day? What does your date book look like? Is your date book empty? If you got audited today, could you produce a date book that gives you all the information, that all the meetings that you attended, all the conferences that you attended, all the sales presentations that you made? Probably not. Okay? Your date book is the evidence. This is key right here. Bookkeeping. If you take your tax return right here, here's your tax return. You should be able to draw a clear line from your tax return to your set of books to your receipts. That's the line. Receipts, books, tax return. Now I don't care if it's a paper spreadsheet. What the IRS said in that audit was they had no way of tracing that back. No way. Okay? So, if you look at these three things, this is what business people do. This is what people, they did not carry on their Amway activity like a business. Okay? That's why they got slammed. So, when you read that, if you look, you can make comments to this video or make comments down below, whatever you want to make. The only thing that I'm going to tell you is this, that I've been doing this now for over 35 years, well over 25,000 business tax returns. That doesn't mean a thing, all right, because I could be repeating the same mistakes over and over again. But I specialize just in home-based businesses. I read audits like this, okay, and then find out why these things are happening. And another thing that they did was the audit people, the IRS, said that it was their first time in a business like Amway. They didn't take any advice. They didn't, they put a dig in there. Oh, they took the advice of their financial advisor who told them not to do it. Well, that's kind of a right there. Who cares? You know what? Plenty of people told me not to do what I do today. Plenty of people, my own father told me not to go into doing tax returns for people. He just says, why don't you be a bookkeeper? Okay? I help thousands of people with their tax returns and build a business. Because if you do these things, you're going to build a business. And you're going to operate like a business. Okay? and you can get advice from people that are in business. Okay? Just like the one thread said in there, you know, people should seek advice from tax professionals. I consider myself a tax professional. Okay, with all that being said, just remember, on the surface it may look like, you know, they got slammed for writing off a lot of their things. And but what you have to do is, in these instances, look deeper. This is the root, okay? This is the root cause of why they got in trouble. Because what happens is, once you file your taxes late, once you don't do all these things, what's interesting is the burden of proof shifts to you to prove all these deductions. The burden of proof lies with the IRS if you play your card straight, which is doing all this right here. So don't let that burden of proof shift. Do all these things that you're supposed to do. Run your business like a business, and you'll have no problems. Steve Spangenberg, make it a great day.